News today that reminded so many of us of the unsettling times that came with those banking failures back in 2008. Tonight, a bank has been seized by state and federal regulators. This is the biggest bank failure since 2008, and this evening, so many customers demanding to know, where is our money? Now, this bank, the Silicon Valley Bank, a favorite of the tech industry. Customers today rushing to withdraw their money, finding branch offices closed and ATMs not working. Tonight here, the White House is pressed. Could other banks be next, and what safeguards are in place?
SVB Financial Group bought some of the safest assets in the world of finance. How could it possibly have failed in 2 days? Here are some questions and answers to help explain what happened. This is V-Circle Future. How did we get here? Well, SVB Financial is the big cheese that owns Silicon Valley Bank, which has a bunch of startups and venture capital firms as customers. When the pandemic hit, those customers were rolling in the dough, and they deposited a boatload of cash at SVB. In the first quarter of 2020, SVB had a little over $60 billion in total deposits. Fast forward to the end of the first quarter of 2022, and wouldn't you know it, the deposits shot up to almost $200 billion. What did the bank do? SVB Financial went ahead and bought a whole bunch of stuff they thought was safe. I'm talking tens of billions of dollars of US treasuries and mortgage securities that were backed by the government. And get this, their portfolio of securities went from $27 billion in Q1 of 2020 to a whopping $128 billion at the end of 2021. That's some serious growth. Then, you may ask why that is a problem? Okay, these securities are pretty much guaranteed to not default. But the thing is, they pay fixed interest rates for long periods of time. That's not really a big deal, unless the bank suddenly needs to sell them. And since market interest rates have gone up so much, these securities are suddenly not worth as much on the open market as they are on the bank's books. So if the bank sells them, they'll have to do it at a loss. At the end of 2022, SVB had unrealized losses of more than $17 billion on its securities portfolio. That means the difference between how much they paid for the investments and how much they're worth now is pretty big. What else went wrong? Well, things weren't looking good for SVB. Their deposit inflows turned into outflows as their clients started burning cash and stopped getting new funds from public offerings or fundraisings. And to make matters worse, attracting new deposits became much more expensive, with the rates demanded by savers increasing along with the Fed's hikes. By the end of 2022, deposits had fallen from nearly $200 billion in March to $173 billion. That's a big drop. And unfortunately, things are only getting worse this year. As of January 19th, SVB was expecting their deposits to decline by a mid-single-digit percentage in 2023. But by March 8th, their expectations had gotten even worse. They're now predicting a low double-digit percentage decline. How did this come to a head? On March 8th, SVB was like, we gotta sell a ton of our securities, like $21 billion worth. But then they did it at a loss of about $1.8 billion after tax. Plus, they're looking to raise about $2.25 billion in capital. So, why didn't it work? Apparently, things went from bad to worse for the bank after the announcement was made in the evening of March 8th. According to the Wall Street Journal, the announcement of the share sale caused the stock to plummet, making it more difficult to raise capital. As a result, the bank had to cancel its share sale plans. Venture capital firms also advised their portfolio companies to withdraw deposits from SVB, compounding the bank's problems. On Thursday, customers attempted to withdraw a whopping $42 billion of deposits, which represented around a quarter of the bank's total deposits. This move left the bank without enough cash to operate properly, as outlined in a filing by California regulators. What will happen to customer deposits? A lot of the bank's deposits are big enough that they don't have Federal Deposit Insurance Corporation protection. According to SVB, there's about $151.5 billion in deposits in its U.S. offices that exceed the FDIC insurance limit. Well, it looks like the FDIC is on the case. In a statement on Friday, March 10th, They said that customers will have full access to their insured deposits by March 13th at the latest. They haven't figured out how much uninsured deposits there are yet, but they will give an advance dividend to those folks within a week. As for the rest of the uninsured funds, those depositors will get something called a receivership certificate and might get future dividend payments as the FDIC sells off SVB's assets. Why are other bank stocks taking a beating? Investors are selling bank stocks across the board after Silvergate Capital's failure, which started with crypto but also reflected a portfolio of government debt whose value was depressed by higher rates. Other mid-size lenders such as First Republic Bank and Signature Bank were also halted on March 10 morning. The impact of higher rates on bank securities isn't limited to SVB. Across all FDIC banks, there were about $620 billion worth of unrealized losses in securities portfolios as of the fourth quarter. Why is the Circle stablecoin USDC getting hit? Circle Internet Financial Limited, the company behind USD Coin, has $3.3 billion stuck in Silicon Valley Bank. USDC is supposed to be worth $1, but it went below 87 cents on March 11th. The idea behind stablecoins like USDC is to keep their value at $1 by making sure the issuer has $1 in real dollars or other assets for every coin in circulation, and that users can always swap their coins for $1. However, just like a bank, a stablecoin can go through a run. If people are worried they won't get their $1 back, they'll rush to get rid of their coins however they can, including selling them. What have we learned? One of the big questions is which banks messed up by not matching the cost and lifespan of their deposits with the yield and duration of their assets. This is different from the questions about bad lending that were a problem in the 2008 financial crisis. During the pandemic, if banks had put money into the shortest-term treasuries or kept it as cash, they would have been safe from the risk of rising interest rates. But that would have also lowered their income. The banks were trying to play it safe, but it might come back to bite them this time. This is the Circle Future. Thanks for your watching.